Talk about using put credit spreads on Robinhood, using Robinhood's option strategy builder. So a put credit spread, like the name suggests, is going to involve puts, and you're going to be entering for a credit, which in turn means you'll have to put up collateral here for this strategy. And so the very first thing that we want to do here is we want to pick a stock that we're bullish on, because generally the put credit spread is a bullish strategy. So for today's video, I'm going to be using ticker symbol LI, Li Auto. Again, these are just examples that I'm showing you here, so don't copy these exact same trades. But let's just pretend that I'm bullish on Li Auto and I want to implement a put credit spread on it using Robinhood's option strategy builder. Let's take a look at how we would do this. So what I'm going to do here is, before I go into the options, I want to always check for early assignment risk, because we are going to be selling options here. Anytime you sell an option, there is risk of assignment. We want to avoid being early assigned due to the ex-dividend of a stock. So always check for early assignment risk due to the ex-dividend of a stock. Now, Li Auto doesn't have a dividend, so I don't have to worry about that here. So let's go into the options here now. And what I want to do is I want to go to the top left here, and I want to find this button that says Builder on it. And I want to go ahead and click on that. This is going to take me to Robinhood's option strategy builder, as you can see the name right here. And the first thing you want to do here is just look at the top here and make sure that you did indeed select the correct stock here. You would not want to enter a strategy on the wrong stock or ticker symbol here. So as you can see, we do have LI or Li Auto selected here. Next thing I want to do here is find the strategy that we want to use. So if I scroll down here a little bit, you should see that under vertical spreads, you'll see put credit spread. That's what we want to focus on here today. And as you can see, right, again, this is a very useful tool, because now I don't have to remember if this is a bullish, bearish, neutral strategy. Robinhood tells me this right here. This is indeed a bullish strategy here. So no longer do you have to remember the names of these strategies, if they're bullish, bearish, how to set them up, because this tool now does most of that for you. So now we can go ahead and click on put credit spread here. Same thing when you come here, just look at the top, make sure that this is the correct strategy that you're thinking of using here. Now, the next thing I want to mention here is I highly recommend that you read more on this strategy. And to do that, you just click on this button here that has a question mark on it. So if you click on here, this is going to go more in depth on this strategy or whatever strategy you're using than what I'm going to go through here, right? You got the basics, then you have, calculations, you have monitoring. There's a lot more information in here. So I would definitely read through this here just to make sure that you have every single thing understood before you enter the strategy. So now let's actually talk about the put credit spread here. So the very first thing I would do is choose a proper expiration date here. So where do we choose our expiration here? So on the top right, this is where you go to choose your expiration. And again, what I really like about this is that not only does it give you the expiration date, but it tells you how many days are left until, that expiration date. So if we take a look here, for example, till January 20, that's 7 days out. If I scroll down, June 16th, that's 154 days out. So instead of me trying to, determine how many weeks is this, how many months is this tells me right away, this is 154 days, right? So you know that information right away. So what I'm going to do, again, for this example here, is I'm just going to go to January 20. Again, this is just an example here. So let's say I wanted my expiration date to be January 20. Again, ideally, we want to be bullish on this stock up until then. And so the next thing I want to do here is let's go ahead and actually talk about how a put credit spread works, how we make money. So the way a put credit spread works is you basically want to determine what price you believe the stock will be above at expiration. So my expiration is January 20. So the first thing I would do here is I would ask myself, what price do I believe Li Auto will be above on January 20 at expiration? So again, let's just pretend that I believe Li Auto will be above $23 at expiration. So what I'm going to do then is I'm going to go ahead and sell a put at that strike price, or whatever strike price is as close to that price you came up with. And then what I'm going to do is I'm going to buy a put with a lower strike. And that's basically how a put credit spread works here. And so that's what we see here, right? We notice that you can't choose calls or puts firstly, because again, this automatically knows this is a put credit spread. You're using puts, so we're only going to allow you to choose puts. And secondly, right, you may get confused because you see this and you're like, well, I only see one option here. You're telling me we need to sell a put and buy a put. Well, we're going to do that, both of them, just by clicking on one of these, because notice here in the first column, we have short/long. And then down here, we see two different strikes. So remember, short is the position you're selling. Long is the position you're buying here. So basically, the first number is going to be the strike of the put that we're selling. Second number is going to be the strike of the put that we're buying. That's how this works here. And so again, if I believe Li Auto, again, let's pretend I believe Li Auto is going to be above $23 at expiration. I want to again sell a put at that strike. So I want to look at short, the first number here, and find 23, which is right here. And then again, what you're going to do after that is you're going to buy a put with a lower strike. So for this one, the put I would be buying alongside of it would be 22.50 strike. Now again, if you want these to be further away from each other, you can change the width here. So let's say I wanted them to be $1 away. I could choose 1 here. And now if I look at 23, now the put that I'm buying is 22. So now they're $1 away. But again, for this example, I'm just going to leave it as 50 cents. So here's the one I would want. So I would go ahead and click on this. And as you can see, Robinhood recognizes this as a put credit spread. We're selling a put at 23, buying a put at 22.50. We're going to enter here for a credit. And then that means, of course, that we would have to put up collateral, $50 in this case, right? Collateral, $50 here. Now, that being said, again, before you even enter the strategy, I think it's very important to visually take a look at what the trade's going to look like. And we do that by going over to option strat here and just visually taking a look at what our profit or losses might be, depending on the date, the share price, implied volatility, all those things. So I'll put a link to option strat in the description below. But what I want to do here now is I want to go to build, and I'll just start with basic long put here. So let's first choose the stock. We're using Li Auto, and then our expiration is January 20th. So let's go over there. And then again, the first thing we did was we determined what price we believed Li Auto would be above at expiration. I said, let's pretend I believe it's going to be above 23. So what I would first do is sell a put at that strike. So let's do that here. So sell a put at $23 strike. And then like I mentioned, we also want to buy a put now, but with a lower strike. So I'm going to go ahead and buy a put now with a lower strike. I chose the 22.51. As you can see, this is a bull put spread, which is another name for put credit spread. It has multiple different names. But as you can see, right, this is very close to what we were seeing over here. Right? This is the same trade here. And so as you can see, for this example, we'd be entering for a credit $33. We'd put up $50 in collateral. So our max loss is going to be collateral minus the credit we received, so $17. Max profit is the credit we received. According to option strat, this is a 39% chance of profit. And then we have our break even over here, which is 22.67. And then again, we can visually take a look at what our profit losses will be depending on, the share price, depending on the date here. Now, of course, we also need to take a look at what happens when implied volatility changes. So here's this IV slider. So if IV drops, notice what's going to change here, right? You should see a slight change here. If IV goes up, you should also see a slight change. So always be aware of what's going to happen when implied volatility goes up and when it goes down here. Now, the last thing I want to mention here is that you can close out of this trade at any point in time. So let's say it's Wednesday, January 18th, and you're up $24. At this point, if you're happy with your profits, you can go ahead, you can close out of it at that point. You do not have to let it expire. You do not have to wait until the expiration date or any of that. You can close out at any point in time. So anyways, if you guys have any questions, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.